We're back. We're back.
We're back. A few pounds heavier from Thanksgiving.
Absolutely. Absolutely.
A lot more turkey.
We were talking about it yesterday. It didn't really feel like a vacation. We had some good food.
Yeah, it didn't feel like a vacation just because me and you were always working on different things, but that's
I
our
worked
fault.
half of
Thanksgiving.
Thanksgiving. We worked all of Friday. But I did have Saturday and Sunday off. Had my daughter's birthday, which was, you came over with your daughter.
Yep.
So that was kind of the highlight of my weekend. You know, she really enjoyed that. So yeah, it was good. It was good.
Good mellow weekend, but
Yeah, it's kind of mellow.
it's Monday. It's
It's
been
Monday.
busy day as usual. What are we talking about today, Ben?
What are we talking about? How apartment syndicators make money, right? So I think that and this maybe that doesn't even have to apply necessarily just to apartment syndicators. I think commercial real estate, we've seen some of these fees that we're going to talk about today, some of the structures that we were going to talk about today across pretty much all commercial real estate. So, you know, we're apartment guys, so we always kind of focus a lot more on that side of things. But, you know, for people that are kind of new to the industry, what to expect, right? How do we get paid, right? How do, you know, the LPs and the GPs, how do they structure a deal, right, where it's a win-win, right? And I always kind of tell people, regardless of the fees, whoever's on the other side of the transaction, if they think that that's a fair deal and they're willing to invest their money, then I say go for it, right? Because we know some people on the East Coast and some of the other coasts, right, that might structure their deals a little bit differently than we do here in Texas. And we're not here knocking on it for in any way, shape, or form, right? It's their LPs are totally fine with their fee structure and the way that they structure their deals.
Yep, there's a million ways to make money. We're just going to go through maybe some of the basics. But that said, Money Mondays use every Monday, 3:30 Central.
Yep.
Right, we're going through different presentations. This week we're talking about how apartment syndicators make money. At the very end, kind of the last 10 minutes, we'll do about kind of a 10-minute Q&A where people can ask any questions, including our topic, including other topics. So
yeah, it doesn't have to necessarily
like Ben
be about
said,
this.
we're going to go through kind of the key things. What are the common metrics that you can expect, the norms? And then from that, maybe we'll talk about some different outliers, right? Like Ben was kind of alluding to, right? In the end of the day, as a buyer, you can buy any deal that makes sense as long as your equity is okay with it.
Yep.
Similarly, right, you could probably charge any deals that your equity is okay with it, right? Mm-hmm. And so, but that said, some people are more investor friendly than others. I think we're very investor friendly. Yep. But again, it's just all in the eye of the beholder. So.
Yeah, no, absolutely. And I think that's if you get anything, if you take away anything from this, this webinar, webcast, whatever we want to call these things that we do every week.
Fantastic Money Mondays, all right?
Money Mondays, right? All right. Is that you can structure a deal 1,000 different ways, folks. So don't take how we do it or some of the examples that we're going to provide as the be-all, end-all of how you can structure a deal, right? Once again, the thing that Ferris said is if the person on the other side of that transaction is all right with it and you can create a win-win, then go for it, right? So some of the types of fees that we see in multifamily, right? I'm going to start off with a couple of the real more, I would say, customary ones. I'd say the most customary one that we see in apartment syndication is asset management fee. Now, that's usually anywhere from 1% to 3% of the total income that the property had taken in the previous month, right? So
what is that? And just to be more specific, right? We're probably going to go through these in the order of, we hadn't really talked about this before the show, but probably go through them through the most common fees.
Yes.
Where every deal has an asset management fee. You almost never see a deal without it, right?
Yeah.
Then we'll start to go into kind of less common. Right?
Yeah,
That's maybe a good way to do it. So
I'll use round numbers, right?
So what is the asset management fee? What does that role do? Because I think a lot of people ask, well, hey, what's that asset management fee? What are they doing? What does it cover? So you want to kind of go
I don't want to get too far in the rabbit hole because we only got 30 minutes, but an asset manager is essentially what we are, right? We are the person that is implementing that business plan, right? So we're the go-between between the investors and the property management company. So really what our job is to make sure to manage the manager, right? Make sure that property management company or that construction company is essentially getting the business plan implemented and getting it done, right? And if not, we have the power to shift and pivot as needed, right? So if the property management company is not doing a good job, right, we can come down hard on them or we can fire them and we go in another direction. We get another property management company, right? If that GC isn't doing a great job, right, we pivot and we go with another GC. We have the power to implement that business plan, and that's what the investors are giving us, that power, right? And for that's a lot of work, right? So what we do is we take what's called an asset management fee. Right? And like I said, it's usually 1% to 3% of the total income. So to make it easy for folks, right, if the property's taken in $100,000, you have 1.5% asset management fee, we would clear $1,500 for that property. And trust me, folks, that does not cover all of our costs. Yeah, but it defrays some of them, right? And that's the reason why we charge
But the
those.
high level things that asset managers do, right?
Yeah.
You know, it's managing the property, doing
Yep.
distributions with the lender, paying out distributions to investor, fielding questions, dealing with monthly financials and write-ups, dealing
Yeah.
with
No,
annual
it's-
taxes. So there's a lot that goes into that, right? And that's
Absolutely.
really what that asset management fee is for.
No, there's a ton of stuff. Like I said, I could spend a whole 30 minutes,
just wanted
and
to
maybe
give people
we've
the
done some
very-
asset management stuff.
Yeah, I just
but
wanted to
we'll-
give people the high level.
Yeah, the
overview.
high level, right, is like you said, right? You're managing the property management company. You're also managing whatever the lender requires, right?
Yeah.
You know, to do distributions or do disbursements when it comes to your lender draws. That's a ton of paperwork, right?
Yeah.
They expect you to do all that stuff as well as working with your investors, fielding any questions and doing distributions.
I just said all that. You wanted
No,
to be
but I'm
quick, and now you're going again.
I'm trying to encapsulate the most important three things, and that's what
We're
that
running
is.
out of time, but here are the 50 things that are due. No.
It's only
So,
three, and I was
but
trying to give the highlighted three. All right.
All
So
right.
all right. So that's asset management, right? So
I
I'd
like
say
to give Ben crap. That's really my
no,
role
no,
here,
you're always
guys.
busting my
but,
chops, man.
So let's
You
keep
know.
going. So,
all right. So I would say the second most common one that I've seen is going to be an acquisition fee. Right?
I would actually say let's talk about the splits and then come back because splits are always there. Then acquisition fee is kind of third. But I agree. Well, I guess now that you mention it, let's go ahead and just talk about acquisition
Let's
fee.
do a couple of the fees, and then we can come back to the structures, right?
Yeah, I
You
guess there's
know,
always
just-
a structure. I've never seen a deal without it. And if you're doing a
No.
deal where it's just an acquisition fee, you got to ask yourself, is there any opportunity in that deal? Because
Yeah, no, that'd be
as
weird.
a sponsor, right, the real opportunity is getting in the splits and the fees and the upside,
Absolutely,
right? Not
yeah,
just the
it-
upfront.
you know, it's all about the upside, right?
Yeah.
You know, I mean, you should not be getting in bed and investing in deals that the sponsor is only just taking a fee, right? You got to
Yeah.
be a little bit leery of that. Why are they doing the deal, right? Are they just doing it just to make a little bit of quick money, or is there some skin in the game down the road, right? But we'll get into structures here in a minute. So acquisition fee would probably be, I'd say, the second most customary
Yep.
one, right?
I'd say, yeah,
You know?
it's pretty customary.
And you can do this fee a little bit differently. It just depends on the person, right? You can do it off the equity that's raised, or you can do it off the purchase price, right? And it's usually anywhere from 1% to 3%. So if you do a $10 million deal, it's 1%. That's $100,000. That's an acquisition fee that's paid out at closing of
to
the
the
of the
entirety
deal.
of the GP, right? So as a GP,
Of the entirety
it's,
of the GP.
it's a way to make it attractive to bring on other partners to help with the various aspects of the deal.
Well, and you got to realize, folks, just to find a deal, it could be 3 to 6 months worth of work. We're putting up at-risk capital. We're going through application fees. A lot of stuff can be lost along the way in terms of money out of our own pocket, right? So just like any other mortgage broker or real estate broker or insurance agent or lawyer, they all get paid at closing. So, that's what the acquisition fee is. It's a way for us to continue to, keep the lights on and keep moving forward and getting and putting together great deals for our investors. So acquisition fee would be one. I would say construction management fee would probably
Construction
be
management fee is another one.
right?
Yeah.
And that's to manage the construction on
And
some
that's
of these
actually
deals.
a very fair fee, to be honest. On
That's a
deals,
lot of work too,
yeah,
right? I would say
we've
between
done deep
asset
value
management-
adds that our investors have home run on, but on our side, we've had to do 10x more work for that deal than other deals.
Yeah,
So-
and then all we took was the asset management fee.
Yeah.
We didn't take. And I did. To be fair, I've done one deal that had a construction management fee, and it really wasn't even that hard of a heavy lift.
Yeah.
But that once again can be anywhere from, I've seen it as high as 5 to 10% and as low as 1% of the rehab amount, right? So say it's $1 million rehab, you're taking 1%, right? That's $10,000, right? And so that's probably, I would say, third on the list of things. Talk to me about some other stuff, right? You've got
so there's disposition fees.
disposition fee. Yep,
So
that's
that
right.
one is basically where the sponsor takes a fee on the sale, which, again, it's another
There's-
whole. There's a
there's
different
arguments
reasons.
on
There's
both
other,
sides.
there's arguments on both sides. Basically, they're taking a fee on the back end. 1% to 2% is probably what I've seen customary.
Yeah.
Right. I've seen situations people do a refi fee because there's a lot of work that goes into a refi.
The refi, I think,
know.
is more justified because on the disposition fee, really, where we should be getting paid is what on the
sale.
the sale that we have, right? We've
Yeah,
got
like on
we've
the
got
fees.
equity.
You mean what we're getting paid is the fees that we had the splits.
Yeah, the splits,
Yeah.
right? The structure. That's really our incentive, right?
Yeah,
Is the
so
more,
if you're getting
the-
if you're home running a deal, you get it on the splits, and
Yeah.
just for the fact of selling it, it's kind of different.
So,
point.
but okay. Well, once
not here
again,
to
we're
dog
not,
on any
we're
one
not, we're
fee
not,
or
we're
not,
not hating
right?
on anybody's fees, right? So disposition fee is another one, right? I'd say
disposition,
refinance fee.
What else are we missing?
I've
We
seen
talked about
loan
construction.
guarantor fees.
Loan guarantor fees. Yeah, I've
Right.
seen that. That's a fair one. So that's probably it. Right?
Yeah, I'd say those are probably the most. And what's a loan guarantor, right? Let's kind of talk about
Person that is basically, in order to take down the debt for these deals, right? There's a lot that has to go into place, including basically people with the balance sheet and the liquidity requirements that the lender requires. So you bring in someone that help with that. There's a fee associated with that. So,
All right, so let's dumb it down a little bit because you went really, really fast with that.
I mean, it's
So,
basically
yeah.
someone that is
No, you got a
getting
$10 million
paid.
loan, right? What do you need?
I don't want to go into the details too far, but long story short, like Ben was saying, $10 million loan, you need to show a combined net worth of $10 million.
Yep.
And liquidity of 25 to 30%, right?
Yep.
Kind of different 10 to 30%, different loans, different lenders do different things. And so, with that said, a lot of times sponsors will just take care of that, but some people have a separate fee because it is we do have to bring in someone. If we're doing a big loan, we bring someone else in, right?
Yeah,
And
as
they
much
get a
as
fee
we'd
for
love
that.
to say that we're worth $20-30 million, we're nowhere close. Yeah. So sometimes you have people that are worth that, and we do know a lot of people that are worth that much, right? And some of those folks, to incentivize them, because there is a level of risk, even though it's a non-recourse loan for the most part, right? There is a level of risk. They say, well, I'm going to charge 1% of the loan amount or whatever it might be, right? And it's usually, once again, most of these fees is 1 to 3%, folks. It's just, what are you charging the 1 to 3% on? This would be on the loan amount.
Yeah.
So those are probably the most customary fees that we see.
Absolutely. So and so let's so before we keep going, right? Money Mondays, we do this every Monday, 3:30 Central. So basically, for those of you tuning for the first time, basically we'll spend about 20 minutes going over different topics. Today's topic is about how apartment syndicators make money. Yep. But we're welcome to go over any topic people want. So if you have ideas, suggestions for future episodes, let us know. And then we'll spend the last 10 minutes on Q&A. So
and just to point out, right, we always talk about apartments because we're apartment guys, but we've seen these on commercial real estate across the board too. So these fees are pretty standard in our industry. It's just, which ones do you throw into the mix, right?
Yeah, so wait, before you keep going, Ben always wants to keep talking. So let's try to look at the comments that we've gotten. So chat says, happy Thanksgiving, you guys. I was out of town. Hey, chat. Hope all is well.
Yep, doing good.
Jefferson says, how was your Thanksgiving, Ben and Ferris? Belated happy Thanksgiving. Happy Thanksgiving to you too as well.
Thank you.
Savion says, what's going on, guys? Can you explain how pref works in the deal? My understanding, the 80-20, 70-30 split doesn't take place until the pref is met. Maybe really high level, or actually, it's fine. Let's go ahead and answer it really quickly. So
it gets into structure,
actually,
right?
We'll talk about it here in a second because we're about to go over the splits.
Yeah,
we'll add it into the splits in a second.
Yeah, splits, structure of how do you structure a deal. Really, there's two different things, right? There's fees, and then how do you structure the split of the deal, right, between you and your investors. And we'll get into the pref.
So Iggy says, hi, how's it going, Iggy?
Hey, Iggy.
Mr. Alex Kogan, I'm your man. I can help on the KP. Absolutely.
See?
Iggy says, hi, chat. And then, okay, we're good to go. So let's keep going. So,
all right, cool. We're moving fast. So why will fees vary between offerings, man? You know what I mean? We've seen fees all over the map, right? Why have you typically seen them different?
Did you want to talk about splits and then come back to that? Maybe
you just want to move on from the fees.
Well, because the splits are tied to that. So it's really the fees and the splits.
All right, so let's talk about structure.
They all change depending on the sponsor, their experience, right? If someone is brand new, they are probably going to give up more of the deal to show people, look, I'm not motivated to make money right now. I'm here to just learn, get educated. You're taking a bet on me, I understand that, right?
Yep.
Versus someone very experienced, long track record, reputation, they might take more, right?
Yep.
And it's also kind of partially about how much meat is on the deal as well.
I would say that's a big
And so
part
if there's a deal that just, let's say I'm buying the deal across the street for $1. Guess what? I'm going to take significant fees on that deal.
Because everybody's, even if you did a 90-10 in your favor, they're still going to make a ton of money, right? So I totally agree.
The real question is, why do I need to syndicate $1? But that's a different question.
That might be a problem.
And so,
I got 99 cents, brother. You got the other penny?
Yeah.
All right, cool. All right, so let's talk about structure because that is important, right? There's once again, folks, there's two different ways.
And this is probably the biggest way good sponsors make money, right?
Yes,
which is
this
on
is how
the
you
upside.
should be making your money.
So what does it mean, right? Most deals have a split with their investors, right? To keep it simple, right? What it really means is, let's say we're doing a deal with a 70-30 split, right? That basically means that after you sell the deal, you give investors back their money.
Yep.
Then you, as a sponsor, are splitting the remaining profits, right? Meaning after you gave them back their initial investment money, right?
Yes. Yep.
70-30. 70% to the investors, 30% to the sponsors. It could also be 30-70, right?
Yep.
And it could be 60-40. So there's a lot of ways to structure that. But essentially, you're splitting how much the profits on the upside is.
Yep.
Now, a couple of caveats. That's assuming there's no pref. I'm about to go into pref here in a second,
talk
right?
about pref here.
But then B, we're talking about a flat, simple split. But there's also what's called the waterfall. Right?
Ooh, yeah,
a waterfall is you add another layer. So you're saying, look, I'm going to give you 70% until you make X amount of money, and then after that, I'm going to take 50%. right? So just be aware that's what a waterfall is, and that's what splits are.
Yep.
And those are the most common way sponsors make money. Right? I mean, the biggest amount of money that you make is on the splits if you do well on your deals, right? So we've had deals that home run that I wish we had a waterfall because we did too well on those deals. But that's really it. And maybe to kind of go over the normal, like what would you say is normal splits? Kind of now, give a little bit of a range, right?
We've seen anywhere from 80-20 to 70-30. That's probably where you're going to see the
80-20. Oh no, we've seen a 50-50, 60-40.
Well, no, I'm saying yes.
Yeah, you mean I'm
getting into the outliers here in a minute, right?
Okay.
I'd say most common, right, is 80-20 to 70-30 in favor of the investors, right? So 20 to 30% would go to the GP, the syndicators, the managers on the deal, which would be me and Ferris in this case, right? And the rest going to our investors. But you pointed out a good thing, right? You gotta realize, folks, they're getting their money back first, right? And all loans, everything is paid back at closing. Then the net proceeds after that is then split, right? So, really it's pretty good for the investor side because now they're going to have all their money has been paid back. Now they're getting 70% or 80% of the deal, right? And once again, we have completely passive investors. All they got to do is fill out 4 pieces of paper and wire in some money, and that's all they're expected to do. So it's pretty good on their part.
Yeah, so now let's keep going though. So now if it had a preferred return though, right?
Let's talk about that.
Now what that means is it adds another layer of complexity, right?
Yes.
What a preferred return says is that, hey, Mr. Investor, you will get an 8% annualized return on your money if I had an 8 pref, right?
Yep.
So 8% annualized return on your money before splits take into effect.
Yep.
Meaning, on the sale, let's say, what does a sale look like? Let's say if we had a deal and I didn't distribute anything, we sold the deal. I first give the investors back their investment.
Yep.
Then I give them 8% return on their money annualized.
Yep.
So whatever's calculation is owed. Then whatever money's left over, that is considered the profit, the upside.
Yep.
And then you're splitting that 70-30, 60-40, whatever. So why a pref, right? A couple things. For an investor, it helps them get almost the closest you can get to a guarantee, right? You're getting,
say the G word.
That's what I said, as close as you can get. You get
word.
basically an 8% return on your money before the sponsor gets a dollar. So as a sponsor, it's really meant to show the investor, look, I'm very motivated to get above that 8 because that's whenever I make money.
Yes.
Right? That's the thing. And then as a sponsor, it's attractive because again, you show your investors that, and because you're giving them that kind of bottom line, right, arguably gives you a chance to take more of the upside. Right, that's kind of how I look at it too.
That's how you should look at it, right? So you'll see instead of a 90-10 or an 80-20, right? You're going to see usually like a 70-30 with an 8% preferred return, right? Because the investor themselves are getting their money back plus 8% every year, right? That's better than the stock market, right? And so and then on top of that, they get all the benefits of just investing in commercial real estate. So and for that, the sponsor usually will take a little bit more of the net proceeds is what I like to say, right?
Yeah, now if you're an investor, the other thing to keep in mind, right, is that there are things such as catch-ups and clawbacks. Go look those up yourself. Those get really complicated, right? But long story short, it might mean that after the investors get 8, then the sponsor gets 8% to catch up, and then it's split after that. So anyways, I'm not going to go into that, but just know that those are terms that you should look in your PPM and make sure.
And you're usually going to have that on more sophisticated operators, right? Maybe, private equity. Some of these guys that are a little bit more, been in the business for a long time, they're going to try to get real crazy with how they structure deals, right? But as long as you're going over it with your financial advisor and with your lawyer and maybe even your CPA, they'll explain all those concepts to you. So you just need to understand what you're getting yourself into, right? Because what one guy or gal might think is a great deal, the other person might not. So you just need to make sure that this kind of aligns with your risk tolerance and where you want to invest in, right? So, I would say the other question that we kind of got in, fees you should look out for, or, maybe that are considered maybe not as customary. Once again, we went from most customary to least customary. I wouldn't say that any one of those, if I saw that on a deal, I'd be like, oh, no way. But we've seen a couple where you've seen all of them.
but which is a fee that you think is not really customary?
I would say a loan guarantor fee
is less
common. Right? I would say refinance and disposition are probably the 3 least common.
What about which ones have we not talked about? I'm talking about like a broker fee. That was the one that came to mind, right?
Well, yeah, but remember, the deal I'm talking about. We saw all those on one deal, right? Where somebody had an in-house broker and we were also paying his fee on top of an acquisition fee on top of all the other fees. And then we were finally
fees all the way down.
It was literally like 6 different fees, and I was just like, no way anybody makes any money on this, right? And so, I wouldn't say if I saw 1 or 2 of those on any deal that would be a red flag. It's more so if somebody's doing all those in one deal, either they got a smoking hot deal, and maybe they did. I'm not gonna rule that out. But more likely, they're either way got a great track record and a great resume, and maybe they can back that up with, hey, even with this, I've made all this money for everybody, or they're just being greedy, right? So there's a time and a place for each fee, and I don't think it's on every single deal you need to charge every single fee, right? That's our own personal opinion. We're not gonna poo-poo on everybody else's way that they do deals. Yep. But so we talked about the structure, talked about the fees. And one thing that we want to take away from this 30-minute webinar here or webcast is that you can structure your deal any way, shape, or form, and there's not a right or a wrong way to do it, folks. So, and we love everybody to comment, like what's their preferred structure, right? Tell us what you think it is, because we're just shooting from what we've seen in Texas for the most part, but then we're part of a couple masterminds, and we know people, outside of our kind of Texas bubble, and they structure it way differently.
And if people have questions about other fees, let us know, right? We're happy to go through
them. The one thing that I'll point out, right? We've seen people where they've almost structured it like debt, right? Where they have no upside or no equity, in the deal, and they're essentially just, they get an 8% preferred, return on, and it's almost like debt. They don't get any of the upside. And we've seen it structured 50-50 and 60-40 in favor of the sponsor, and every which way, shape, or form after that. So, but yeah, no, let us know. Ask questions. That's what this is all about. We're just all learning together.
Yep. Yeah, so with that said, if anyone has any questions, comments, go ahead and leave them. We'll go ahead and answer them live. Going through a few more comments. Ronnie says, "What's up, guys? No plaid today. No plaid today."
Hey,
we wore our semi-professional dress shirts.
Yeah, I'm trying to.
We wore the Disrupt Equity colors. Ben wore the dark blue. I wore the bright.
I'm usually gonna have blue on. Most of the time, that's usually or like a gray or a black.
All right. Savion says, "Good stuff. Keep staying consistent. See you guys next Monday." You too, Savion. You're consistent as well, my friend. So thank you.
No, we appreciate that, man.
All right. If anyone has any more comments, questions, go ahead and leave them. Otherwise, let's just keep rolling. So,
what else we got?
What else we have to talk about, right?
Open Q&A.
What do we have coming up? So, in what, 2 months? A little over 2 months?
Yeah, a little bit more. February 27th, 2021. Right. We're going to have our next Multifamily Investor Network Conference. We're really excited about it. Yeah. We're gonna bite the bullet. We're going to do it right. COVID safe. But we're going to get back to doing some networking, and we're going to do it right here in Houston, Texas.
Yes, and so our last one was in Houston. We had to cancel the other two due to COVID.
Yep.
But we will do it again in February, right? Yeah, everybody get your vaccine shots beforehand.
We'll
be spaced out. They'll be cleaning stuff as well.
Yeah, we got masks and stuff. We're going to do it right, you know. But, in our business, folks, it's all about networking. It's a relationship business. We'll still do our monthly webinars and all that stuff too, and we'll still continue to do Money Mondays. But we really wanted to kind of get back to throwing on this conference because we love it.
The conference is fun. It's just a chance to network. We lose money on every one of these stupid things, but it's a lot of fun. And it's putting together people in a good environment to learn, educate, network, and that's how you grow in this business. We like to say it's all about your network. So
we had the mayor of Houston last time. I always like to point that out. We were really lucky to have Sylvester Turner.
Yeah, we're going to try for that again this time.
We're shooting for the stars. We're going to see if he's available. Obviously, a lot of things have changed.
Iggy, I expect to see you there this time. All right, you got to plan it. We're giving you the date in advance. I see your comment. Nice, Kathy. Hey, again, sure appreciate these. You're welcome.
Yeah.
And it's it's the cheapest tickets ever, right?
Absolutely. And Shannon, if we could go ahead and push it over to the next slide here. There we go. No, what are you doing, man?
You mean next slide?
This slide, man.
There
Come on.
You said next slide.
I know, but we didn't have it on.
Ben's terminology. S and slide, both screen and slide start with the same letter. So
I'll
give you the benefit of that out there. All right.
I get confused easily. So no, it's early bird special. This is the best pricing we're going to give, folks. So check out mfinvestornetwork.com. mfinvestornetwork.com. And check it out. You got $100 off there, and that goes through December 4th. So check us out. We're going to have a ton of speakers, ton of opportunities to network. Once again, we'll have some cool keynote speakers that are going to probably talk about all kinds of crazy stuff.
Yeah, so check it out. So let's get back. So if anyone has any more comments, questions, chime in. I know Iggy asked a good question. For a heavier lift or shorter hold, would you charge a higher asset management fee? Not usually the asset management fee, right? That's kind of a fixed, right? You don't really see that one change. If I was doing a heavy, let's say I'm doing a deep value add, right? I would, you're going to make your money on the splits. Well, construction management for sure, but just take higher splits. If it's a deal you're having to do a ton of work on, right? You got to be compensated. I mean, you really look at it from my perspective. If I could spend, I'm just making up numbers, right? If I spent 20 hours a month on one deal, and the other deal took me 90 hours a month, and they both netted me the same, well, clearly it doesn't make sense. I'm going to be more motivated to just not do a 90-hour a week, a 90-hour a month deal, and just keep doing deals that are 20.
And I feel like we've done a couple of those 90 hours.
Oh yeah, we've done a couple of those 90. Our investors loved it, right? But again, it doesn't make sense versus being compensated appropriately for the heavier lift, but it needs to make sense too for your investors, right? Yeah. From their perspective, if they can invest in both of them, and they're making the same, why would they go on the riskier deal? So it needs to make sense. But usually you're not doing it on the asset management fee increase. You're doing better splits, right? Maybe a disposition. So waterfall, right? There's other things that you would do to kind of help move it in your favor, right? Where your investors are protected, and then you're also protected.
I always say it's opportunity cost, right?
Yeah.
If I can make just as much money doing an easier deal, why wouldn't I do that, right? Versus spending a ton more time to make the same amount of money. So we look at that same thing. We'll still do those heavy lift deals, but I think we'd structure them a little bit differently. But we're opportunistic, and ultimately everybody knows we're still looking for a deal. So, throw us a deal. We'll look at them, even if they're a little hairy. We've done deals that have down units, and we've done lease ups and everything.
Ben
else.
lost his hair, so he
All
can
my
do
hair
your
is
hairy
gone
deals
because of those deals.
So if you have hairy deals, let us know.
I still got to pay for the hair transplant. So we might have to have a little bit better split on that deal. But no, I'm just joking. So yeah, that you brought up a good point, right? It's all driven by opportunity cost.
Yep.
So,
all right.
What else we got, man?
Any more comments, questions? Iggy says, thank you. You're welcome.
Yeah, thanks,
again,
buddy.
You glossed over what I said, Iggy. I expect to see you February 27th. Let's come out here.
Where's he at? Is he on the West Coast?
East Coast. So,
He's on the East Coast?
we'll let you work on Ben's teeth, right?
Hey.
He's a dentist.
Probably did need a little bit of work. It's been a while.
He probably cringes at us drinking these coffees every time we're on this show.
Every single time. This is a prop. There's actually not any coffee in these.
Yeah.
I'm just checking. There totally is.
Yeah. All righty. So if anyone has any more comments, questions, please go ahead and chime in. Otherwise, let's go ahead.
There's a lot of fees. I think
he said too funny. Yeah, you're welcome.
No, I'm surprised that more people don't want to talk about this, right? Because this is how we get paid, right? And that's how, if you're willing to put your own.
It's kind of swept under the rug, honestly. Like sometimes,
no, we're gonna put it out there, right?
Quickly rush over that information.
No, every single time, every webinar, what's the question that we get? Acquisition, how much is your acquisition fee? How much is the asset management fee? They never ask about the deal or the area. No. So as a syndicator, you're gonna have to be prepared, right? And justify. Don't shy away from it. Own it, right? We put a lot of work and sweat and blood and tears into finding these deals and then operating them, right? There's a ton of risk that we put up ahead of time. So, these are customary in the industry, right? So don't be shy about taking them when justified, right? Don't be greedy at the same time. It's a fine line, right? But I'll just leave you with that.
Yep. So with that said, let's go ahead and wrap it up here. If anyone has any more comments, questions.
Well, what are we talking about next week, man?
Hold on. We are talking about what are the risks of investing in real estate syndication.
Well, we just talked about that, right? There is definitely some risks, right? And that's why you structure deals differently too. So we'll tie the two together. I think that's actually a good segue, because that's why you might have a higher fee or a different structure depending on the risks of the deal, right? But we'll also look at it from the LP side, which we are as well, right? An investor. And how do you size up risk, deal to deal?
Absolutely.
Right? So cool. I'm excited about that one.
Awesome.
All right.
With that said, we got a question. Can you do a session on how to split the GP portion between the GP partners?
Yes, we can.
Yeah, that's actually probably a good one, right? Yeah, that's a good one. We'll do that. No, thank you, Kathy. Yeah, that's a good idea. Just kind of different ways we've seen the GP get sliced and diced.
Yeah. Everybody has to have a role. You can't just it can't be all about equity raise.
Yep.
It has to be some substantial effort into it. So we can kind of talk about the legal ways to structure a GP as well. Yeah, I think that's a good point.
Yeah. All right. Well then, with that said, let's go ahead and call it a wrap. So going once, going twice. Money Mondays every Monday, 3:30 Central. Right. We will see you guys again next week.